Welcome, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions as a point of reference to you, the viewer. We expect you to make your own financial decisions. Hey, Blockhead Traders. In this week's episode, we're going to take a look at some open plays that fellow Blockhead Trader Viper XL 007 and myself actually have on. And we're also going to go fishing for deployment of some new capital and screen for some new plays. But before we jump into some of the tickers that we want to talk about this week, I want to give a shout out to our Discord channel. You can find a link in the description below, and we'd love to have you click that link, join us in the Discord, say hello. You can interact with ourselves, you can interact with other traders in the community, ask any questions, make some comments for upcoming videos that you'd like to see, even talk about what you didn't like in the videos we've already released. So check that link out, say hello in the chat room, and we're going to jump to some tickers this week. So in this week's episode, Viper and I kind of thought we'd talk about a little bit of some open trades that we have on, things we've learned from the open trades, things we're still looking to get out of the open trades. I myself have a little bit of capital that I'm looking to deploy. I'm kind of in between those monthly cycles that I like to do. So I'm kind of closed out most of my July contracts over the past week or so, and looking to deploy some new capital into August expiration and things like that for some options. So we're going to take a look at a couple of tickers. And one of the first ones that we want to bring up is a ticker that I believe Viper has been playing.
Yeah, so I made a play. I'm in a play, just open shares. So I didn't do any options trading or anything on this. The reason this crept up on my radar is we can kind of see, out here, there was this really big, off a cliff drop here, where we came down, and that perked up on the radar because that causes a huge volatility premium spike, as we've talked about before on naked puts. So that day, I mean, I'll zoom into it in a minute here, but that happened over a span of just a couple days. And so I went and I charted the rest of this. And so what we can kind of see is we have this long steadiness at what will ultimately be a $14, $15 level here. And then it spikes up and then it comes back down. So this was especially interesting to me because now if we go ahead and zoom in here to most recent, the key thing to understand in that was that $15 level goes all the way back to the beginning. And we can kind of see here as we zoom in, this pinkish, purplish, or whitish, whatever it looks like to you, is where I bought, which is this guy over here. It's not necessarily a recommended purchase level. I'm kind of gambling a little bit on my bullish attitude towards this. Really, what we want to see is a closing day above this $15 level, whatever it closes at. We just need a day to close up here. And the reason we need that to close up there is that effectively will establish the $15 level, reestablish, which is a very important historic level. And then once we establish that, if we shrink this down, let me zoom back in. If we shrink this down on the way up, so let me slide back over here to once we established the $15 level and we went to the big spikes up. This happened, in a day, which is we're looking at the daily chart, and you can see in this area here, there was not really any action intraday on the way up. So what we end up seeing then is, so there's really no resistance back here on the way up. And so what we're looking for is once we establish that $15 level, we want to know where's the next resistance going to come from. And so if we look at on the crash on the way down, we do see a little bit of a blip here around this 25, 26 level. And so I find that especially interesting, meaning once we establish the 15, there's a lot of blue sky with little resistance. There's always the opportunity to find new resistance, but historically speaking, little resistance at least until we get to this 25, 26 range. So that's kind of what I'm looking for out of these shares. Like I said, I potentially bought early. If I was sticking to the fundamentals and the rules, then I would have bought, waited for that clearing close above that 15. But curious as to what you're seeing on the options front, because I imagine a lot of that premium crunch that happened here on this drop is I'm guessing worn off. But what are you thinking on the option side?
Yeah, so let me bring up the option chain here. And yeah, so you're absolutely correct about the volatility really kind of be deflating out of this particular play. There's still a good bit left, but let's take a look here at the chart just to kind of graphically see how this volatility deflated out of this play. So right here is the 1 year chart on the CCXI. It's a daily chart. And one of the things I always look at when I kind of am looking at particular premium is, this particular underlying has about 100% volatility in the August expiration cycle. And that's all relative, right? I mean, 100% might be real low for this particular stock. I don't know. And so a lot of times what I'll do is I'll plot the implied volatility as a secondary chart when I'm looking at this. And you can see in this big drop here that occurred on May 4th, the volatility did start to spike up here to about 200 and almost 30%. It kind of settled out here in these coming days, but then as the price actually was kind of coming back, you can see that the volatility really ramped up again to about 250% and kind of stayed elevated. So this area where you might have thought the volatility was kind of settling down, it actually was quite high, and only within the past maybe trading day or so, you get this real fall off in volatility back down to about 116%. So where it's currently at, yeah, it's kind of a little bit in the middle of the road for this particular stock. However, when you're dealing with some of the premiums and things like that, this 106% volatility in August is not a bad place to consider some premium selling. You can see that a delta strike of about a 28 delta is going to be about $100 in premium, $105 in premium. And when I'm looking at option plays, I'm really looking for liquidity. And this one seems to have plenty of liquidity. The bid-ask spreads are pretty tight in here. And, the first strikes that I like to look at are usually between 16 and 30 delta. And for just a put side, I go a little bit higher on the delta. So I typically start around a 25 delta. So right here with the 28 delta, this is perfectly within my realm of kind of a trade entry. And so if I look at kind of selling this, I look at this spread, I figure it's about 105 with 924 buying power. If I was to actually go ahead and size this position up for my particular account, I always take double the credit received as my bailout price. So I'd be collecting about, let's call it $100 here on this trade. And so I'd kind of slide down this P&L chart until I reach about a $200 loss, which looks like that's going to come around $9.50. So I'd look at my price slice here at $9.50 is what I set this at. I don't really care about my top side. And what I'm looking to do is probably have a position size where my margin at this price slice is probably around, I'm going to say between $2,600 and $3,000 is where I like to see it. So I'd go ahead and bump these contracts up to probably 3. And so you can see this is at 3,000, but I'm collecting $300. So this would put my position size in the worst case position at about 2,700. And so for my position sizing, this is a $300 play here that I would put out there. And, my break-even price is down here at 1150. So anything above 1150, and I'm going to walk away green. And if I look at the chart that Mike's kind of showing, No, there's quite a bit of support at like 950 seems to be the low, I think, in the chart that he had showed. So that's really my bailout price. And so you can see this one's pretty comfortably statistically in that range. So that's how I would set up an option trade on this. So the next stock ticker that we kind of want to look at is FSLY, and both Viper and myself actually have positions on FSLY currently. It was a ticker that we came across a while back, and I opened up a covered call strategy. Viper opened up a different style strategy that he'll probably speak to. I is experimenting at the time with covered call strategies as kind of an entry point, and so far it's been working out okay. I'll kind of touch on after we kind of go through some of the chart analysis and how it's looking here with Viper. I'll kind of touch on a couple of drawbacks that I'm really seeing with the particular strategy that I deployed to play FSLY. But I'd go ahead and let's see what Viper is actually seeing in some of the price action with FSLY.
Yeah, so for me, FSLY is, I don't know, I guess as you go along your trading adventure, you're going to find biases, or you're going to find things that you make money on consistently, or you just learn the ins and outs of how it's moving. For me, FSLY's been one of those. I mean, I don't even know what I think early on in the pandemic, it brought to my attention because of the underlying company and what they are. But whatever it is, it's just been the gift that keeps on giving for me for a while. And historically, we had this, playing down here in the 20s. Let me grab a pen here. Kind of played around here, and then as we start to get into May 2020. Pandemic sets in, and FSLY is a technology company, web serving, all that kind of stuff. So then they really spiked up. And what I've loved about it, in how I've played it, how I played it last summer, was, I mean, look at the volatility, or the variant, the swings. These mountain swings here. It just swings heavy. And so that was a lot of what I played on. This was a big swing player for me. And I just settled into being very comfortable with that because it has such large swings to it. Then as we got towards the end of 2020 and then into 2021, it had this dip off, and I kind of fell out of it for a little while. And now I came back. It came back to my attention. I was randomly poking around, trading view, different ideas, the different idea streams, and I saw FSLY. The last time I played around with it, it was up in the 70s and 80s range, low or upper 60s, low 70s. That was the last I knew of it. And then all of a sudden I saw somebody's trade idea, and they were mentioning it down here in the 40s, and I was like, whoa, whoa, whoa. So I went and I looked at it. And sure enough, there was this was an earnings catalyst, where it just dropped and came down to this 40 level. Now this is where you can get into trouble, is the bias that I had towards this stock. That seeing 40 when I'm used to seeing 80, instantly makes me kind of bullish. But through some price action analysis and whatnot, I really liked it at this level. So I decided to continue my history of swing trading it. Options premium was really good. This was a big premium juice drop here. So I did sell some naked puts because I did catch it kind of in the early days of this drop when the premium was just kind of crazy on it. So aside from that, then I've been swing trading it. And a big thing that I noticed when I read the chart is this gap here, and I won't scroll back. I won't scroll back now, but this gap is largely devoid of resistance. And so what I was especially interested in on my swing trades was leading up to that gap, in order to catch the gap. But it's going to get up there. It's going to get to the bottom of the gap in this level, just like we see that it did. It's going to get to the bottom of the gap before it actually makes the jump. So I entered some positions around the time that Sprocket 888 did, and I played some of these swings, and then around this area here is where I really kind of dumped into it. Let me zoom in a little bit. Feeling the gap was coming. So sure enough, we gapped, and we gapped right as expected. Just a clean up shot to this upper level here now, where there was historical resistance on the chart. So once it established there, I still kept playing some of these daily swings that you see here as it was toying with this new level. Then again, what I really liked was this pennant pattern that we see forming here, pennant or flag pattern, whatever you want to call it. And the swings were also decreasing. There was just a lot of compression, a lot of consolidation. So then again, this was another swing that I decided to jump on because it was consolidating. This white bar is not a level. That's just where I bought in most recently. But ironically, that is also where I bought in at that pennant pattern. And then it finally popped. And then, at the top of this swing, you never hit the top. So don't believe me if I'm implying that I did hit the top, but I did catch this swing up once the flag broke, and it broke to the upside. And then we see this resistance at the 65 level, and it actually came back down to where that pennant had previously cleared. So this is my play currently, where I bought in at 5630. As you can see, that's what this white bar is, just my own notation. So anytime I view this chart, I know I have an open play on it. And so I'm back in after this swing back down. This doesn't work forever. So I have a stop loss in here just to be careful on it, because it's not going to go forever. But I still like lower resistance, at least to the 65 level, but we'll see what happens. So that was ultimately my play, was swing trading it with a beginning naked put. Sprocket, you took a different strategy. So what did you come out with on that?
Yeah, so I did take a slightly different strategy. I don't follow Fastly anywhere near as much as yourself. But yeah, this was a stock that basically Viper tipped me off and said, hey, this had a huge gap down after earnings. This was several days after earnings. The price had kind of slowly been building up. And he said, I think this thing could cover the gap here in the near future. And so I remember looking at some of the option plays there, and a lot of the options were heavily called skewed with premium, meaning that equidistant from the price, there was a lot more premium in the call side options than there was in the put side options. So playing the naked put at the time didn't seem quite as lucrative, I guess. And so the strategy I deployed was actually a covered call. And I thought, oh, this is great. I'm gonna go ahead and I'm gonna snap up 200 shares of Fastly, and then I'm gonna go ahead and sell a call against those 200 shares. Actually, I sell two calls against those 200 shares, and it kind of would serve, if this thing really did cover the gap as Viper was suggesting at the time. That covered call would net me my premium that I collected from selling the call, plus it was going to give me an exit point at my strike price, which I chose at about a 30 delta or 25 delta, I believe, which happened to be a 55 strike. And so what I have pulled up here is actually my P&L chart specifically for this play. And effectively what I was doing was, if it didn't reach that 55 strike, it didn't cover that gap as Viper was suggesting, now my cost basis for entering Fastly was about $2 lower than where I actually entered it. So you can see on my P&L chart right here that I entered Fastly 200 shares at 48.92, and I sold two call options at about $2 each. So that nets my break even on the actual bare shares at around $47. And the benefit here is that if this thing actually covers the gap and rallies like where it's sitting right now, these shares will get called away from me at the 55 strike, and I will make the as if I sold them for $55, because that's what would happen. But the one thing that I was kind of paying attention to here, I actually did two of these covered calls, one on Fastly and one on Beyond Meat. And there's actually an unintended consequence that an experienced option trader that does this type of covered call all the time will probably say, yeah, no, duh, this, how could you miss that? But there's a little thing called buying power. And I am all about capital efficiency. I want my money making money for me all the time. I don't ever want it just sitting around. And so I want to basically take the capital that I have, and I want to make sure I am maximizing the returns on that capital. And one of the things when you sell options, you basically cannot sell options without cash to cover it, basically. So there's in any brokerage account, you have stock buying power and you have option buying power. And stock buying power, you're allowed to basically buy and sell stocks on margin. So the extra leverage, usually 2-to-1. Options, you are not allowed to do that. And so if you have $10,000 in cash, you're allowed $10,000 in margin. You can only have as much margin as you have cash. You cannot use leverage with options. Well, brokerages do an interesting thing when you don't have cash, but you have shares, because shares are kind of a stored value. They're not quite as secure as cash, but they're also not really leverage per se. And so what brokerages do is they basically will let you use 50% of any share's value as option buying power. So what I mean by that is if I had $10,000 cash, I get $10,000 margin in option buying power. If I had $10,000 cash and I bought 10,000 shares of stock, my buying power margin for options would be $5,000. So they basically cut that value in half that you have in stock and give that back to you in buying power. And the hit here that I didn't really fully grasp until I watched this thing kind of play out, and between Fastly and Beyond, I started scratching my head wondering, why don't I have so many option plays on right now in this particular month? And I started looking back to say, well, all my positions are sized correctly. What's going on? And basically what's happening here is I am losing my margin to sell options because I have 200 shares of Fastly tied up here. So the net lick on this particular Fastly position is like $11,000 right now. So $5,500 of my buying power is gone on this particular Fastly trade until I close it out. And in addition, there's also some margin requirements because I sold the options or sold the calls on there. So I have like $7,000 of buying power tied up in this Fastly play, and I can't put other options on because it's this money that's kind of tied up in these static shares, which aren't necessarily kind of paying me back throughout the days. And so that's just something that you need to be cautious of when you get into these strategies, the wheel strategy, which is where you're basically sell naked puts until you get assigned, and then you sell covered calls against those until you get assigned. I'm not saying it's a bad thing. It's just something I wasn't really expecting, and I need to kind of shift some of my position sizing and expectations because this particular covered call is actually tying up more of my buying power than I had anticipated, which is basically decreasing my capital efficiency.
And I would also add then, correct me if I'm wrong, that your stuck in that situation until assignment because the current closing price today was 56.86. So that's in the money on those covered calls that you sold. So there's no getting out of that without, taking an unnecessary hit. So you're just kind of stuck until assignment clears this whole thing up. Is that correct?
Yeah, to an extent. This is something. So normally, whenever I have like a potential profit target, I'm always exiting at 50% profit, and you can see on my P&L that if I was to really exit today, I would walk away with about $1,300. If this was expiration and we were where we were, I'd walk away with $1,600. And so what's happening there is I'm getting more money for my shares, but I'm paying that back in intrinsic value to close out the option. And so the difference there is that gap and the extra premium that's left in that call option. That's the distance from this blue line to this purple line is the extrinsic value in the option. So the intrinsic value is basically a wash because I'm selling at 56, $1 in the money, but I also have that option price already has $1 in the money in intrinsic value. And so that's really a wash between that. So I could exit now and walk away with $1,300 versus letting this thing ride to expiration. And I'm kind of thinking to let it ride potentially. And what I could do is if this thing happens to dip below 55 just before expiration, I could close it out for pennies. And if I wanted to keep that 55 target as a strike price, the premium for next month's 55 strike is going to be super high because that's going to be right at the money. So, I mean, if we just take a look right now, the 55 strike is at $6.55 right now. Now it's $1 in the money. So, an at the money position would be about $5.55 because you're about $1 in the money. So that's an option, but I also have to weigh that against the buying power tie-up that I have here because those are positions I can't actually open because I'm tied up in this, and is that trade-off worth it? So one other thing, I'm kind of also in the hunt for a couple of position plays, and one of the things that I've really been into trying to put more and more positions on because it really leverages that capital efficiency are basically options on futures positions. And you can go back to last week's episode and take a look at quite a disaster that came out of options on futures. I have a lot of other success stories as well, so I'm not ready to throw in the towel yet on futures options. But one of the things I kind of periodically kind of look through on the tickers is to say, hey, what futures are kind of in the premium range as far as volatility goes that we might want to open up a trade on. And one of the ones that jumped out to me is actually natural gas as a potential option trade to put on for futures. And I've really been playing around with the days to expiration with futures because they pack so much more extrinsic value in them that I almost feel like my 45-day rule entry is a little bit too long, and that kind of getting in some of these options closer to expiration around maybe the 21-day might be a little bit better or see some of that decay come off a little bit faster. And one thing to actually make note of is a lot of futures contracts, you have to check them because they are all on different styles of options. But a large percentage of futures options are actually what are known as European style options. And in European style options, there is no such thing as early assignment. They can only be assigned on expiration. So that's kind of nice because it takes the whole early assignment risk off of the table. It's not even a consideration with European style options. Most equities are American style options, and so they do carry that early assignment risk. And so when I look at natural gas, if I just kind of pull up a chart real quick on natural gas when I'm kind of looking at this, since March, volatility has been relatively low. It's been a lot more volatile in the past, so we're a little bit lower on volatility over the past year than where I kind of like to be. But on these short plays, I'm not quite as worried about it. The volatility is elevated slightly, so it's around 44% volatility, which is really good in the futures world for a lot of these things. And a lot of times in futures, I'm pretty happy anytime we have volatility over 35%. You can see that natural gas is really trading at almost an all-time high. So there's a lot of sentiment out there that clean energy is really going to drive more natural gas usage because we're not ready to transition to some of the other fuels. The economy's coming back, which is ramping up production and things like that. So in general, there's a lot of bullishness in energy across the board, oil, natural gas, things like that. Now, I tend to think that, when you're pushing up against these really all-time highs, it's really hard to kind of push a lot higher. And so for me, when I'm kind of looking at this chart, I'm thinking like a horizontal play here, where the amount of time that we have left here, it's probably not going to move that much. And so the first strategy I would kind of look at playing here would be a strangle. And usually when I'm entering strangles, especially on futures, which have such high notional value, they represent very large dollar amounts in the underlying contracts and futures, is I'm probably going to start no higher delta than 16. And I might even consider something lower down to like a 10 delta. But let's go ahead and take a look at like a 16 delta here. Strangle. So if we take a look here at the option chain, we are going to look in here around a 16 delta. There's not really a 16 delta available. There's a 15 available, an 18 available, just kind of due to the overall more bullish tilt that I have on natural gas. Probably going to go ahead and set my put at the 18 delta, which is the 335 strike. And we'll scroll down here to look at the call side. There is a 16 delta available on the call side. But again, we kind of have a little bit more of a bullish tilt. So, and we kind of bumped up the deltas on the put side. So I'm going to go ahead and go with a slightly lower delta on the call side. So let's add in this 420 strike on the call side to the trade. So now we have a strangle. This is what I would call basically a 16 delta strangle. If we look at the P&L here, I've already kind of marked up my bailout price on the high side, my bailout price on the low side. This is going to be double the premium of 730 collected. So that's going to be a loss of about $1,400 on each side there. And, looking at the position sizing here, about one contract is correct for me, because you come out here to these bailout prices and we're talking about $3,400. So if we take off that 730 premium, that's right in that sweet spot for me. And what you'll kind of notice is, because we went with the 21 days to expiration, as I kind of simulate here, we're pulling in, $47 in theta a day in theta decay, which is just awesome to get that much theta out of options plays. And as we kind of pop through this, you can see around this price range, it's gonna pay off pretty quick with that decay. For right now, what we're looking at today, you can see this gray region is the expected move of natural gas for the position to expiration here. So this is definitely a play that I would going to consider watching. I like this strangle even a bit more if we get a little bit of a drop in natural gas prices in the coming days. So I'm going to kind of watch it to see where it comes. The closer we bring that put side down to this, down to the 21-day moving average, which I have charted on my chart here, you can see historically it kind of comes down to this 21-day, bounces off, comes down to 21-day, bounces off. So a great entry point, at least from a put side, would be if it's touching the 21-day. Where it's at now is more of a strangle play, because you're kind of likely halfway between your top side and your bottom side. So playing both plays right here. But if we come down, it might turn only into a just a naked put play. And then if we start to get a rally up, potentially add a call to that. And that's basically the natural gas trade that I'm potentially looking at. So that brings us to the end of this week's episode. Like I said, make sure you check out the Discord. Love to see what tickers you guys are watching. If you guys have trades out there similar, you have any feedback or questions on any of the trades we mentioned in this particular episode, love to chat about it with you in the Discord channel. Leave a comment on the video below if there's any kind of videos you'd like to see in the future, topics you'd like us to cover, things you'd like us to go in depth, things you want us to experiment with in our trading strategies and trading plans. I'm always open up for new ideas. I know Viper is as well. We're always looking for new things and new strategies to try to build out kind of our variety and flavor that we have. So good luck this week. Have fun out there. And remember, think outside the block.